Welcome to this explainer. Look, today we're getting right into the actual mechanics of scaling modest initial capital, something like $100 a month, into a really robust six-figure portfolio. Now, if you've been optimizing your personal finances, you probably already know the theory, but today we're going to dig into the exact execution strategy and the underlying math you need to actually get there.
Okay, let's start with a really simple but powerful question. Imagine waking up to deposited income without even working for it. The ultimate goal for any of us is generating yield without trading hours for dollars, right? It's a universal objective we're all striving to optimize. But rather than viewing passive income as some elusive late-night infomercial dream, we really need to treat it as a straightforward mathematical equation that we can actively solve and leverage to our advantage.
Here is our roadmap for today's explainer. We'll cover the biggest wealth myth, the power of compound interest, passive income accelerators, costly mistakes to avoid, and finally, your wealth action plan. Let's get to it.
Section 1, the biggest wealth myth, you don't need thousands to start. I absolutely love this comparison because it just lets the math do all the heavy lifting for us. You've got a 20-year-old putting in a mere $100 a month, and they actually end up with a bigger portfolio than a 35-year-old who is practically scrambling to catch up by investing $500 a month. The secret sauce in wealth generation isn't the giant pile of cash you start with. It is literally just the sheer leverage of time in the market.
Moving on to Section 2, the power of compound interest, and specifically the S&P 500 engine.
Now, to build that kind of wealth, you obviously need a highly reliable engine, and the S&P 500 is essentially the ultimate set-it-and-forget-it vehicle. Why? Well, it naturally self-cleanses. It automatically boots out the losing companies and pulls in the winners, which is a massive reason it historically maintains that rough 10% average annual return over the long haul. Let's be real, trying to day trade or blindly pick the next Apple or Nvidia is stressful, and honestly, mostly a fool's errand. For sure, consistency in a broad index fund is just your absolute best friend here.
So we all probably know the textbook definition of compound interest, but I want you to think of it purely as the mechanical lever of your portfolio. Your capital generates a yield, and then boom, that yield steps up as fresh capital to generate even more yield. It's basically the financial physics that makes long-term investing actually work.
Just look at this staggering disparity over a 30-year timeline. Your actual out-of-pocket cash commitment is what, $36,000? But that relatively small chunk of change gets completely swallowed up by over $164,000 in pure snowballing compound growth. It's wild to look at. So that translates to a portfolio of well over $200,000, all from just $100 a month, which, if you think about it, is really just the cost of a daily coffee habit or, a couple of random streaming subscriptions. It's not magic, no way. It is simply mathematical consistency and letting your capital work its tail off in the background while you go about your life. All right, Section 3, passive income accelerators. It's time to fuel the fire. To really hit the gas on that S&P 500 engine, you're going to want to build multiple cash-flowing assets. And rather than going through every single option on the planet, let's just zero in on the really high leverage plays. For instance, if you look at the services and brand column, using AI-powered freelancing is a real game changer because it lets you scale your output exponentially. Or over on the investing side, real estate investment trusts or REITs let you collect that sweet, regular real estate yield without any of the headaches of managing physical properties or, fixing leaky toilets for tenants. The whole strategy here is just to set up one of these cash flowing channels and immediately funnel those profits straight back into your index funds. Section 4, costly mistakes to avoid and protecting your wealth. Look, we've all seen people absolutely wipe out their gains by making completely unforced errors. Sitting around in cash just waiting for the quote-unquote perfect time to enter the market, that is a guaranteed way to lose your money to inflation. Then there's panic selling the second the market does what markets do and naturally corrects. Or, and this is definitely my personal favorite, risking your hard-earned capital because you blindly followed some unverified viral investment advice from a teenager on TikTok. Seriously, don't do it. Protect your downside by staying disciplined, tuning out the short-term noise, and keeping your eyes fixed on that multi-decade horizon. Bringing us to Section 5, your wealth action plan. These are the steps to execute today. If you really want to know the secret weapons here, they are absolutely steps 3 and 4, automation and consistency. Opening a brokerage account and throwing in $50 or $100 is obviously your baseline. But setting that account to auto-invest on the first of every single month and literally refusing to stop no matter what kind of panic the financial news cycle is screaming about, that is how you structurally, mathematically guarantee your success.
I absolutely love this quote. Knowledge compounds just like money. Because at the end of the day, your absolute highest return on investment asset is always going to be your own human capital. When you constantly level up high income skills, whether that's AI implementation, digital marketing, maybe some coding, you are actively increasing your earning baseline. And that just gives you way more dry powder to funnel right back into your portfolio.
So, as we wrap up this explainer, I really want to leave you with this final, kind of provocative thought. If someone walked up and handed you $1,000 right now, today, what would you do with it? Would you invest it or would you just spend it? Because true financial independence, it's not some random windfall. It's a series of highly strategic, compounding decisions. So the question is, how are you going to choose to allocate your resources right now? Think about it. Take that next analytical step, and we'll catch you next time.